How many signed up?
I'm not sure. I didn't ask. I'm not sure. I know we put it to the region as well, the Virginia to state.
Yeah, this isn't a glamour topic, that's for sure.
Okay.
It's
But it's
just
still it's a good necessary topic.
no, it's definitely a necessary topic. It's definitely good, but it's not like subject to or hard money or, some of those other things.
Yeah. Yeah. Yeah, but it's good when these various scenarios come up, you know how to handle them, you
Oh
know?
yeah, no, you got to have that tool in your toolbox.
Yep.
Yeah. Um, this is how we financed our rental portfolio with
Oh, okay.
Sandy Spring is through one of these loans. We've had these
Okay.
loans for a long time with different
Okay.
banks.
Okay.
Yeah.
So we'll wait like one more minute, Charlie, and then we'll get started. And it's being
Yep.
recorded.
Okay. Yep. No rush. It's on your guys' timeline.
Okay.
See, this is why this is so perfect because Fridays are like the best day for me to do it.
That's awesome. Nice to know we can pick your brain on Fridays.
Yeah. Yeah. It's unlike you guys, right? Because you guys are probably busy, what, Friday, Saturday, Sunday, for the most
Yeah.
part, Monday, whereas I'm busy Monday, Tuesday, Wednesday, Thursday, and then my weekends aren't so bad.
Okay.
So it's kind of like opposite a little bit.
Hmm. Okay, Charlie. So I'll go ahead and introduce you so we can get started. Thank you for everyone for tuning in today. If you've been tuning in since the beginning of the month, this is part three today of our special guest, Charlie, who's been giving us, dropping all these golden nuggets that, um, man, this stuff would cost you a lot of time and heartache, and he's giving it to us for free to prevent us from taking a bumpy road. And he's a wonderful resource. I can't say enough nice things about him, actually, and all the things that he's willing to just share with us. We have that, we have Charlie, we have what we call a Monday morning miracle call. And it's an inspirational call that we do, and we bring on guests and stuff. And it's pretty much about mindset. And one of the things that I really love about you is you really don't have a scarcity mindset. And when you share, it always comes back to you more abundantly, right? When you share. So we appreciate your time. And so I'm just going to let you dive into your topic for today. And it's already being recorded, so you just go for it, just take it away.
All right. Thank you, Nikita. Thank you guys for having me again. Let me know when you guys can see the screen that I've shared. Can you guys see it okay?
Yes, we can see it.
All right, good. Um, again, thanks, Nikita. Thanks, Exit Realty, for allowing me to do this. This is the third part of a four-part series that when Nikita first brought it up, I was like, oh my gosh, how am I going to have time to do this? And how am I going to be able to put all this material together to cover, each of these topics in at least an hour? And so, we're doing it. This particular topic, debt service coverage ratio loans, it's not that I'm personally doing them myself because when I talk about uh, hard money lending, we do that. When I talked about subject to finance deals, I've purchased many, many properties via the subject to route. But in this particular case, with debt service coverage ratio loans, um, we have actually been a participant on the borrowing end of loans as far as debt service coverage ratio loans are concerned. And primarily for us, we've used them to refinance our rental portfolio. And so at one point in time, we had three different 16 property debt service coverage ratio loans with three different community banks. Now we consolidated all 48 with one bank, and Sandy Spring has our debt service coverage ratio loan on top of all of our properties. So that's kind of nice for us because we only have to make out one loan to a bank, which is nice. So with that said, for those of you that are new, welcome. Those of you who have been here, welcome back. During my talks, what I like to do is if you guys have any questions on a particular slide, ask it and I'll answer it right away, because if it's on the top of your mind, I want to get these things answered right away. So feel free to ask whenever you want. Remember, this is for you guys. I've done this many times, so this is primarily for you guys and to help your learning. And so the more you can learn about this particular loan option, the better it will be for you guys as agents and or investors. I know I have a lot of agents on here. Hopefully I have a bunch of investors on here too. So this is a very good tool for buy and hold investors. Um, Similar slide that I've done in the past. This is who I am. I changed it up a little bit. At Charlie Einsman, follow me on Instagram. We just, believe it or not, I just started Instagram like a month ago. My son made me start it just because of the book and education company that we're about ready to launch. So that's my call sign on Instagram. Follow me. Let's see, we just recently put out a book, The Roadmap to Wealth and Real Estate Investing, that came out in December. So we're pretty happy about that. We're on the bestseller list in 3 categories. I have a lot of real estate experience, as you guys know. For you guys that are new, just kind of read over some of my experience. I don't want to go over it again for those that have been here for the third time. And if you've been here for the third time, thank you very much. If you're here for the fourth time next week, you're going to get a gold star award. So welcome everybody. This is who we are, Clear Sky Group. I've got a bunch of companies out there and they do different things. The first one is Clear Sky Properties, LLC. We have about 50 rental properties in our portfolio. They're all residential. We still fix and flip houses, 1 to 2 a month. Basically, uh, we have referral sources coming in for our fix and flips. I don't really go chase them anymore like I used to. We own an industrial parking lot for semi-truck trailers. It's by the Manassas Airport. It's a 3 acres, and so we rent it out per space. And this is for semi-trucks, semi-tractor trucks, their trailers. The next company we own is Clear Sky Financial. We're a hard money lender in DC, Maryland, Virginia, North Carolina, and Florida. I operate out of 2 funds. So I'm also what's called a fund manager. It says there we have 35 million on the street, but this month, end of January, we recently eclipsed $40 million. So we're pretty happy about that. And so that's a very profitable company on the hard money side. I did that presentation last week, the X's and O's of hard money, and that's kind of was our business and our business model. Another company is Clear Sky Holdings. We do primarily tax lien certificate investing, DC and Maryland. Virginia, we don't, because Virginia is what's called a tax lien state. I'm sorry, it's a tax property state. So if you're late on your property taxes, they auction off the property itself. Whereas DC and Maryland, they auction off the tax lien certificates. So we're a big player in that space. Montgomery County, PG County, and DC. Clear Sky Auto, we own that. So we own an auto body shop and a tire shop, but we just own the real estate. I don't own those businesses, so we're just leasing that out. So, and then we just launched what's called Clear Sky Education. It's www.roadmaptowealth.com. And so we launched a pilot course, and we've got 4 online courses coming. And actually, one of the courses is how to find the money in investing in real estate. And this is one of the modules of that course, how to find the money. And there's various ways to do it. And so this is sort of a model of what our book is modeled after. What we do is, this is the roadmap to wealth, right? And so what we do is we take somebody with no money, no knowledge in the investment space. We educate them on the fundamentals of real estate investing. We educate them on financial literacy of real estate investing. We then teach them how to create leads, create their own leads, like distressed assets, foreclosures, pre-foreclosures, REOs, estate sales, tax lien properties, hidden market, so on and so forth. And then once we do that, we teach folks how to find the money, which is all these topics that I'm covering. There's a few more, but next week I'll cover 3, because I'll cover HELOCs, I'll cover assuming VA loans and assuming FHA loans, so you guys can understand that. And then what happens is once you know how to find the money, we'll teach you how to wholesale and or fix and flip. And the reason we do that is because we want to teach you how to build your capital stack. And that once you have got your capital stack built, whether it's through fixing and flipping or wholesaling or even your real estate commissions, then what you want to do is at the very end of the roadmap, you want to be able to use that capital stack money and create your residual income stream. And so we call it residual income stream. You'll hear it called passive income stream. And so we go over the things that you can do with that capital stack to create your own passive income. And so eventually what's going to end up happening is that your passive income is going to equal your monthly expense footprint, and then you're considered financially independent. And so some of the passive income streams that we teach is, how to become a hard money lender, how to invest in a pooled mortgage fund, kind of like we have, how to build your residential rental portfolio, how to build a commercial portfolio, how to do tax lien certificate investing. So we're actually taking you through this entire roadmap all the way to the end. And so we're pretty proud of that. This is our model. We've got it trademarked. And this is basically what the book's about, is taking you from nothing all the way to passive income to replace your financial monthly footprint. Okay, house purchasing options. You guys have seen this slide before. If you're repeaters, so we're at the bottom of this DSCR loans, and I'll talk about what that is in a second. But that's what we're going to cover today. If you're here for the pre-foreclosure class, it's somewhere else. No, I'm just kidding. So here we go. All right, what are we going to cover today? What is a DSCR loan? I'll cover scenarios, why you want to use it, why you don't. We'll cover the difference between a conventional loan. You can obviously get rental conventional loans versus DSCR loans, so I'll cover that. I'll go through what a DSCR calculation is, how the banks use it. It's pretty straightforward. You guys will understand it. We'll go through the DSCR process, requirements, documentation, just the whole process to start getting a loan to the finished line of getting the loan and closing it. And then we'll talk about how to build your real estate portfolio with a DSCR loan and how we do it to this day with many of our borrowers. And you guys can get a good feel for how you can use this to not only purchase investment properties and refinance them and keep them for the long term, but you could also, if you have investor clients wanting to buy and hold, this is a good tool to use to do that. And so what is a debt service coverage ratio loan? Well, basically what it is, it's a loan for buy and hold investors, right? And so what it is, it's a cross between an asset-based loan and a normal traditional conventional loan. And what I say by that is that the asset stands on its own, the income of the asset. So that's the differentiator between a DSCR loan, but they are going to require certain documentation from you. Like you're going to have to fill out an application. They're going to have to check your credit. And then you're going to need to prove the income on the property, so on and so forth. But it's not as document intensive as a conventional loan. And they use, like I said, the income of the property as a key qualifier. Now, this can be done on a single property or a portfolio of properties. But my discussion today is only going to revolve around the single property, right? In our case, like I was talking earlier to Nikita, was that in our case, we've used DSCR loans for probably 15 years, but primarily we've been using it with the community banks. And so the community banks are set up so they can do more than one property, as we have more than one property. And so right now, I've got a very large DSCR loan with Sandy Spring Bank on all of our rental properties. And they were very critical about giving us that loan because they were using the income of all the properties as the qualifier for a good sized loan. And so that took us a while to get that loan closed. It took us about 90 to 120 days because we had so many properties and so many appraisals and so much of this and so much of that. But that's my experience level with it. I've also got experience level with my clients on the hard money side, buying rentals, and then they refinance them out with DSCR lenders. And so primarily what a DSCR lender does is they lend to LLCs. This is a business to business loan, not like a conventional loan. They might loan to an LLC or to you as a person, but this is only LLC specific. And so the next thing what they do is they require a 20 to 25% down payment. but I have to caveat that because that's not really true. Um, if you're buying a property and you're using a DSCR loan to originate it, they will require a 20 to 25% down payment. If you have purchased that property, let's say with a hard money lender, and you got it at a pretty good size discount. Let's say you bought it 70 cents on the dollar, you did a rental grade renovation. What you do is once you've owned that property for 6 months or more, you could get what's called a stepped up appraisal. And so all that stepped up appraisal needs is a 20 to 25% equity position. So you don't really have to put up any cash to buy a rental property if you use the hard money lender to DSCR loan. But if you're just buying it and originating with a DSCR loan, they're going to probably require 20 to 25% down payment. The other thing that they require is 3 to 6 months interest reserve. Currently, currently they want to see a 660 credit score, but in another chart that I'm going to show you, the credit score is much lower. But I'm also going to go through a pricing chart that you're going to look at, and anything going down to 570 or 560, the pricing jump is very, very expensive. But really what you want to have is a 660 score or above. And the other thing about these loans is that they're very flexible. You could actually choose your AM schedule. I've seen 30 years, 25, 20, and 15s. I've never seen anything higher than 30. So I'm not sure. It just depends on who the lender is and who the investor behind that paper is. But I've never seen anything higher than 30. And so the other thing too, you could have multiple loans as far as number of properties, because if you're, let's say, borrowing on a conventional loan, technically it used to be you're only allowed to have 10 loans in your name, 6 with the same bank. But as far as DSCR loans are concerned, it's an unlimited amount of loans. The only caveat is that these properties have to be cash flowing so that the lender, wants that loan. Any questions yet? Okay.
I do.
Okay.
Hi, this is Dilcia. Okay, I have a question in regards to the if I bought a property with a conventional loan, not
Yeah.
with the SCR, and I have that property already rented, it hasn't been 6 months yet. Can I get some refinance? I did upgrade the property, added bathrooms and 2 bedrooms.
Oh,
So
that's good.
can I use the DACR? Can I you just mentioned something about step out?
Yeah, you
appraisal,
can. You
something?
can. So, but I'm going to ask you a question though back, because is your current lending product, is that a 30-year AM?
Yes,
Okay. What's the interest rate?
7.
Yeah. So and I'm going to show you a pricing sheet later on in this presentation. So
Okay.
you're at really the cusp of whether to do it or whether not to do it, because as you're going to see in next charts coming up, is that the DSCR pricing right now is a little higher because of what's going on is the interest rates have gone up.
Mm-hmm.
Whether the feds have raised rates. So where these DSCR products used to be around 4%, 4.5%, you're going to see in the chart coming up that they're hovering around 7%. So my advice to you would be to hold tight for a minute. If the
Okay.
Feds reduce rates another 2 or 3, 4 times, like they probably will, because it's a presidential election, and those rates start coming down to, let's say 5 3/4, then I would go ahead and refinance it with a DSCR loan. And then by you have adding the value to the property that you did, then you're going to be able to get a nice stepped up appraisal on that property. And you might even be able to get some cash out. So, but I would wait for interest rates to drop before I thought about doing this.
Okay, thank you.
All right.
And same thing with at the HELOC, right? Do you know anything about HELOC, or you
I
don't do
do.
HELOC
As a
at
matter
all?
of fact, it's funny because that's the presentation next week.
Okay, perfect.
It's
Thank
on
you.
HELOCs and assuming VA FHA loans. So the thing that I would do is I always advise people that, number one, get a HELOC on your owner occupied property, especially if you've been there for 3, 4, 5 years or more, because we've had such a great appreciation. So put a HELOC in there. Basically, guys, if you guys don't know what a HELOC is, home equity line of credit, it's a checkbook against your house. So go apply for a HELOC, get that checkbook. But don't use it on vacations. Don't use it to buy a boat or a car. Keep it out there. Use it for investment purposes. And so a HELOC is a good way to use more leverage to further, buy more properties. And so I'm a fan of HELOC as long as you use it the right way. Okay. Scenarios for DSCR loans. This loan product type is for buy and hold investors. And so this is for people buying and holding. And so there's a couple ways you can use it to buy the property outright and use a DSCR lender. A lot of people will buy they'll buy the rental property in distress, right? So they'll get it at a good price. They'll put some rental grade renovation into it, throw a tenant in there. Now, a lot of folks like to use DSCR products as a refi tool, and that's what most people use it for. You can do a cash out refinance, especially if you bought that property. Let's say you bought it for 65 cents on the dollar, right? And then you put 5% renovation budget into it, or maybe 2.5, get it rental ready, and then let 6 months go by, get it seasoned, right? You guys know what that means. Seasoning basically means the length of time you've owned a property. And then once you've got it seasoned, get a new appraiser, get a new appraisal, and then you're going to get a new appraised value. And then that's the starting point of the loan. So then they'll take 70% or 75% of the appraised value, and then that's the loan that they'll give you. And they'll make sure that the income is there to verify that, to justify that as well. These are longer term loans with fixed interest rates. So like I said, a lot of people will use it to get out of a hard money lender loan, because most hard money lender loan interest rates are ranging anywhere from 9% all the way up to 13, 14%. So they'll use this to refinance their hard money lender, which is a good move. You can select your own amortization schedule. I've seen 30, 25, 20, 15s. I haven't seen anything above that, but you can do that. And, you know, just like anything else, it's further leveraging of your business, and you're using other people's money. And so these are good scenarios of why you're going to use DSCR loans. And so traditionally, what has gone on with buy and hold properties is you got, you know, a variety of buy and hold income models. And so they will qualify you on the shorter term income models. But, you know, obviously the first one is your traditional rental model, where you have a normal 6-month, 12-month, 2-year lease, kind of like what we do. All of my rental properties are all traditional. I don't have any Airbnbs or VRBOs. We thought about, I had a house over there on Edison Street, North Arlington, that we just sold actually on Wednesday, that we tried to sell it last year in the fall, but we couldn't sell it. I think we were asking too much money for it. And then we took it off the market, put it back on the market after Martin Luther King holiday. And so we thought about actually renting that property out for traveling nurses. But we didn't do it. We sold it. It's just because it was too expensive of a property. But we thought about doing that. But all of my rentals are just normal leases. So you got the traditional income model. You've got the Airbnb model. I think we all know what that is. The VRBO model, vacation rentals by owner, traveling nurses, house hacks, room hacks, all these kinds of things. Now, the problem is on the income side with the shorter term rental models from a DSCR lender, and it all depends. It's all depending upon who's doing the loan. Sometimes if you're doing an Airbnb, they might make you have income of that Airbnb 6 months to a year already. They're not going to look ahead to the future. Then some might allow you to predict the income model as long as you have a pro forma. So each lender will take that under different requirements and different underwriting criteria. So you just got to get to know a couple of those DSCR lenders. And that's basically the rental buy and hold model. And so that's kind of what DSCR loans are for. And so let me compare conventional loans versus DSCR loans. So a conventional loan, usually nowadays, if you have a rental property, they want you to be around 620. Now, obviously, all of these parameters change. So just talk to your local mortgage person and ask them what their criteria is, because, these things are always changing. 15 to 25% down payment on a conventional loan, 2% of reserves of the unpaid balance is usually the rule of thumb for rental properties. A debt to income, they're going to have a debt to income up to 50%, but the debt to income is your personal debt to income. And I'll cover the difference on the right side on DSCR loans here in a second. And the interest rates are usually 1% over prime. I'm not sure exactly what the prime is, but prime is kind of expensive these days. And so let's look at DSCR loans. Credit. Now remember, 660s or above is what they like to see, but they'll qualify you as low as 580. And so then you're going to ask yourself, you're going to say, hey, what are you talking about? You're saying this is an LLC, right? So what they do is they take anybody that owns 25% or more of the LLC and they pull your credit. So if you have two 50-50 partners in the LLC, they're going to pull both of yours. If you have 4 25% partners in the LLC, they're gonna want to pull all 4 of your credit scores. So just be careful of that requirement. Again, that's something that changes all the time. The 580 changes, the 660 changes. They require a 20 to 25% down payment. But remember, I talked about what that kind of means. It means 20 to 25% down payment / equity, but they don't really let you capture the equity position for at least 6 months. And each lender is different. I don't know any DSCR lender who will do it in 3 months. Most of them will require at least a 6-month seasoning. So just keep that in mind. They also will require 6 months reserves. Now, 6-month reserves means 6 months of the payment. So if the payment's, $2,000, then they're going to make you show an account of $12,000. Again, this is the DSCR loans is the middle game between a hard money loan of hardly any documentation and a conventional loan of of a lot of documentation. So a DSCR is an asset-based loan, but it does have minimal documentation, less than a hard money lender, but more, I'm sorry. Yeah, less documentation than a hard money lender, and a conventional loan is going to have more documentation. So just be wary of that. There's no debt to income. They don't care about the debt to income ratio because they care about the debt service coverage ratio, what that is, and I'll cover that in the next chart. So it doesn't care if you have no income, no job, it doesn't matter. It's about the income coming in on the asset in its entirety. They're not concerned with anything else. Interest rates are going to be a little bit higher. So if you're looking at a conventional interest rate versus a DSCR interest rate, the DSCR is probably going to hover between 0.5 and 1% higher. So just keep that in mind. You can close in LLCs. As a matter of fact, that's all they do. LLCs, Incs, Incorporateds, whatever corporate entity you have out there. But primarily it's an LLC to LLC loan. And then there's no max number of loans. So that's basically the difference between a debt service coverage ratio loan and a conventional loan. Okay. Here is how they look at this thing called a debt service coverage ratio. And basically what it is it's a fraction. It's a number. They like it to be a whole number, which is greater than 1. That's what they look at. So basically what they do is they take the property rents, right, in its entirety. That's on the top of the fraction. They divide it by the principal, interest, taxes, and insurance payment of the property. A stands for association dues. So they're going to take your condo fees into consideration. They're going to take HOA fees into consideration. And if you have both, just simply add those up. And so that's the bottom of the equation. And so, for example, if the house is pulling in, let's say $2,500 a month in rent, the payment is $2,000, then your debt service coverage ratio is 1.25. It's simply 2,500 divided by 2,000. And so the other way they look at this is that the higher the DSCR, the lower the interest rate. So if your DSCR, banks love it if it's at 2. I've seen that every now and then, but usually I see anywhere between 1.1 to 1.7, 1.8, but usually 1.25 to 1.5 is kind of what they look for. I've seen some banks, they'll only approve the loan at 1.1 or higher. So if you're at 1.1 or lower, like 1 or 0.8, then you might have to go find another lender. Again, this is the lending underwriting that changes all the time. So you're just going to have to find out what the current underwriting restrictions are or how they underwrite at a current time, because these underwriting criteria is changing because rates are changing all the time. So you just have to be wary of that. Let's see, no personal income requirement, kind of covered that. And so that's basically how that works. Some DSCR facts. If you have a DSCR of 1, that's basically where the income and the debt associated with the property is the same. And so that happens, but some banks will do that. They'll loan 1, and I'll go with that when I go over the pricing chart, which is kind of a big chart. I'll explain how they do it. Like I said, lenders prefer a DSCR ratio of 1.25 or higher, right? Kind of like the example I showed earlier. And then their ability to service the debt is on the income of the asset itself, nothing else. They don't take anything into consideration, which is why this is a really good tool. Because if let's say you're a realtor and you're a fairly new realtor and you don't have 2 years of income that you can report, they don't care, right? You're not going to get into that. Let's say you just started your own business and you're making a little bit of money. They're not going to use that as a qualifier. It's the actual property itself. The property stands on its own. And basically, here's the process. So what the borrower does is, you're going to have to fill out an application, pay for an appraisal, show the property income. And so there's a bunch of ways of showing it. Let's say you're purchasing the property as a DSCR loan and it hasn't been rented out yet. What the majority of the DSCR lenders will allow you to do is just provide them with rental comps. So as long as you provide them with marketed rental comps, then they're going to be able to approve your DSCR using that income. Now, if you're going to buy a property and use it as a short-term rental, like an Airbnb, a VRBO, or traveling nurses, it's not going to be that simple, because they're probably going to make you wait 6 months to show provable income. Like I said, other agent, they might just be able to do the loan on a marketed income, like what the market value is of a rental if you did a year lease. So if you're going to go short term and purchase a property using a DSCR lender, just make sure you understand the requirements of a short term rental because they change. And I don't want you to think you're going to be able to get a DSCR loan with a short term rental. This is the first time. They're going to be pretty strict about it. And then you're going to provide additional loan documents as needed. Whatever else they require, you're going to have to get an insurance policy, just like you would do with any other normal loan. So then what the lender's going to do is they're going to review the appraisal. They're going to review your credit. They're going to review the property income. They're then going to calculate the DSCR, compare it to your credit, and then compare it to the program that you want. And then you can lock the rate. And so I'm actually going to show you guys today's current pricing of a DSCR loan, but this is only with one lender, right? So this isn't in stone. This is just with one lender. And then I'll explain how the investor's concerned, how they sell these DSCR loans into the secondary market, because there are investors that have pooled mortgage funds like insurance companies that absolutely love this product, but they have a starting interest rate that they want to get. And so then once that happens, the lender does their due diligence. Then just like anything else, they draft you a term sheet, which is the offer sheet. It's going to have the loan amount. It's going to cover the terms, right? Interest rate, when the payments are due, so on and so forth. And then it's going to, give you a 30-year AM schedule. If the 30-year AM schedule is, if the payment's really, really low and you want to pay this property off quicker and you want to increase your payment, but the shortness of the term, then you can say, hey, I want to go to a 25-year AM. I want to go to a 20-year AM. But one of the caveats is that for us, since we use community banks to be our DSCR lender, like I've used Bergen Herbert in the past, I've used Freedom Bank of Virginia, I've used Revere Bank, and now we're currently with Sandy Springs Bank. So I've used a lot of those community banks as lenders. But in our case, they only will allow us to do a 25-year AM schedule. So I've got 5-year loan periods. And so at the end of each 5-year period, even though it's a 25-year AM schedule, they will recalibrate our interest rate. So my interest rate isn't fixed for 25 or 30 years like it is with a normal DSCR lender. It's only fixed for 5 years. And so once the 5-year term is up, then the interest rate goes to whatever the prevailing rate is. So it's either going to go up or go down and maybe stay the same. Lately, we were lucky that we refinanced our rental portfolio right before interest rates started going up. So I'm in a really good interest rate environment at like 3 7/8 for the next 5 years. And we did that right before rates started going up. So I've got another 4 years that we can keep that loan product out there before they're going to recalculate the rate. So I was fortunate on that. And then the next thing is you close the deal, right? And so any deal closing on a DSCR loan is similar to any other loans that you're getting. Promissory note, deed of trust, lender's title insurance, certain lender fees, that kind of thing. So the closing is exactly the same. It's just a different loan product that's out there. Okay. Can you guys see this chart okay? Yeah? No one's complaining? Okay. All right.
Yes.
This is basically how they do it, and I'm going to cover this in these 1/3 quadrants. So the minimum base rate for a State Farm, and this is a State Farm as the investor, and they're the ones. So what happens is a DSCR lender will originate the loan. Once the loan is originated per, let's say, State Farm's requirements, then they just put it into the pooled mortgage fund that State Farm owns. So in this particular case today, State Farm wants at least a 7% interest rate for their investor loan portfolio. And so then what happens is if you look at your credit score, right? So see where it says 725 to 749? Basically what they're doing is they're going to price it. So if you're above a 750 credit score, right, at the top, and if your debt to income, if your loan to value of the property is 60% or less, so let's say my property's worth $500,000 and I'm only going to get a $300,000 loan, then your pricing on that loan is at the very best that they're offered, 7%. See the zeros? Now, if you have 35% equity or 30% equity or 25% equity, then your pricing changes. You see a minus 0.25, a minus 0.5, a minus 1.75. Those are basically the points on the loan. So right now, if I was at greater than 750, 40% equity, then I would be at 0. So I would be at 7% and 0 points. And that's basically how this pricing matrix works. And so that's the top left-hand third, right? So this is divided into thirds, right? So that's the top one third. Okay. Then what they do is once they figured out your credit, right? Then they figured out how much the property has appraised for and the loan that you're requesting. Then there's certain loan products that you can do, right? You can do an interest only 5-year. You can do an interest only 10-year. You can do, then they have loan amounts if it's less than 200,000 or in between 200,000 and 750, if it's 750 to 2 million. So all dependent upon what loan, how much the loan is and the loan product. They also have pricing on top of that. Then if you look at the right-hand side of this, then you'll start getting into the debt service coverage ratio. So if you go let's see, all the way down, where's my debt service coverage ratio? Okay, if you go to the third row down on the right hand, you'll see DSCR of 0.8 to 1. Do you guys see that where it says DSCR 0.8 to 1? Okay, that's a DSCR less than 1, right? But remember, I told you that if the debt service coverage ratio is less than 0.8, you're going to be paying a lot for it. You're going to be at 2% higher, right? You see the no ratio DSCR 2%. You're going to be 2% higher. But if you're at a DSCR between 1 and 1.5, then you're going to get much better favorable pricing. So it just all depends on your scenario based upon how they price the loan. And so it's very important for you to realize that. And so if you look at the second where it says 3 to 4 unit properties, they like for whatever reason, they like these kind of properties better. And they'll actually give you a 0.25 discount off the rate, which is good, and off the points either way. And so all depend upon how much equity you have. They like these properties a lot better. And the reason why they like these properties better is because you're not dealing with just one property and one tenant, right? You're dealing with 3 or 4 tenants. So if one tenant moves out, then your income is still pretty good on that 3 to 4 unit. That's why it's priced favorably as far as your program is concerned. Any questions on this pricing matrix? Again, I just put it in here just so you guys can kind of see how they come up with the interest rates and how to price it. Now, the base rate of 7% fluctuates, plus this whole matrix fluctuates. So you just need to talk to your DSCR point of contact. If you don't have a DSCR lender, I've got a couple good ones that I could refer out. I don't broker these loans to other DSCR lenders. I just refer them out to a loan officer. I've had companies approach me to see if Clear Sky Properties wants to become a DSCR loan broker, and we've just turned it down just because we're so busy on the hard money side. I don't want to get bogged down with stuff. Any questions on that? Okay, advantages of DSCR loans.
Sorry, you said you would give us the list of those awesome lenders. Is that
Yeah.
like an
Yeah, I could do that.
email or right now or either way? Thanks.
Yeah. No, I think it'll be, well, I think what I'll do, Liz or Nikita, I'll email you a couple of good sources. And then send it out to your team because I obviously don't really know who's on here. All right.
Thank
Yeah, I
you.
could do that. No problem. Yeah. And again, they'll share. because I don't know if they're gonna share you guys their pricing matrix like they shared with me, maybe. The reason why a couple of these guys shared it with me is because I do refer DSCR clients out. And the reason why it's very important to us is because as a hard money lender, I need a good DSCR partner because I need the money back so I can relend it. For us, it's all about short-term loans, short-term lending, 6 to 9 months. I want the money out. If it's a DSCR takeout, I want it back. I want it out. I want it back. So for me, it's very critical that I have a good partner who can do these takeout loans because it helps me with my liquidity. Okay, advantages of DSCR loans. Flexibility, right? We talked about the flexibility of the AM schedule. We talked about the flexibility of your equity in your property. We talked about the income flexibility, trying to figure out how to derive more income from that property. They do accept house hacks. They do accept room hacks. But like I said, if it's that kind of scenario, you're going to really need to do a good job of keeping track of the income and try and figure out how to increase the property. I know we're in Virginia, but in California, I'll explain to you what they're doing out there is that they've got these things called ADUs on their property. So let's say I have a single family house with a 2-car garage. Let's say it's in San Jose, California. What they're doing is they're allowing people to convert the garage into 1 or 2 bedrooms and 1 bath. That's called a junior accessory dwelling unit income. Then you have the income of the main house. And then you have another option to build in your backyard, another 1 level, 2 bedroom, 1 bath called an accessory dwelling unit. So the garage is a junior accessory dwelling unit and the backyard unit is an accessory dwelling unit. So you can have 3 income streams on 1 property. Now, I was in talks with the city of Manassas recently that they're thinking about approving an accessory dwelling unit program in Manassas City. So stay tuned to that. So what's going to end up happening is that the laws and the movement to enable people with single family houses to create accessory dwelling units, that's going to come to an area near you. And so that wave is starting to come to the East Coast. So that's something for you guys to think about. Arlington County is already doing it. There's a bunch of accessory dwelling units on lots in Arlington County on the single family houses. So that's being done to this day. You just have to go through the permitting process to get a ADU approved, not to be confused with an affordable dwelling unit. That's totally different than an accessory dwelling unit, but these loans are very flexible. So try and figure out how you can increase the income on a rental property.
Quick question.
Yep.
So to get the ADUs, do you have to have a certain lot size?
You do. So what you need to do is if you're in a county or an area where it's in their existing code, then I would look up the code. So just go to the zoning office. They have a book of code, figure out are you R1, R2, R4, and then figure out your zones, your lot size, and then go look at the code. And guys, what I mean by R means R stands for residential. 1 in Virginia stands for 1 acre, 1 house per acre. R4 in Virginia, for the most part, stands for 4 lots per acre. So if you're R4, then you could put a house on a 0.25 acre. I've seen R8, R16. So you got to just understand if you have a single family house, what your lot designation is, and then figure out your lot size and your tax record, and then go to the zoning office and find out if they'll allow you to put an accessory dwelling unit on your property. Like I said,
Awesome.
it's not mature right now in this area, but the wave is coming from California. And the reason why I know a little bit about California is because I have a couple of one of them I have what's called a shared appreciation mortgage on a property in San Jose, California, where I'm a lender on that property, but I'm also getting a 25% shared appreciation of that property. And we're actually converting the garage to a junior accessory dwelling unit, and we're building accessory dwelling unit in the backyard. And this is in San Jose, California. And we're taking that value from a $1.2 million value all the way up to a 1.8 because of those income streams. And so those income streams make your property a lot more valuable. And so keep that in mind. Multiple loans, multiple properties. That's why we like about it. Just remember, there's a 10 loan limit on the conventional loan side per your personal name on your SSN. It used to be 10 loans and 6 with the same loan mortgage company. Those things are always changing too due to underwriting criteria. So it's maybe not an exact science, but that's what it used to be, 10 and 6. DSCRs have the flexible AM schedule. We talked about that a couple times. I do say interest rates are an advantage. Interest rates was a big advantage about a year and a half ago because the interest rates were really, really low. Now they've crept up a little bit, but because of the flexible AM schedule, you could get a 30-year AM, so your payment's not that bad. So just look into it. They're changing all the time because of the rates, and they'll come down this year, is my guess, in the first 6 months, because there's a presidential election year, and so they'll fluctuate down. Some lenders can go down to a 0.8 DSCR, but but they're going to require a 70% loan to value. If they're going to go lower than that, you're going to get really priced high. And so I would be careful. You're going to get actually crushed on pricing. So it might not be worth it. Commercial properties, they can go 5 units or higher, right? So commercial properties, 5+ or more units. Actually, yeah, it's 5+ or more. The interest rates are going to be a little bit higher. So where I quoted you guys a 7% bottom of the barrel interest rate, if you have a commercial property with 5 units or more, it's probably going to go to 8 and 8.5 starting rate. So the commercial properties are going to be higher. What are the disadvantages? As you guys can see, I put interest rates. Right now, certain matrix categories have really, really high interest rates. Right now we're at 7. Like I said, this is the highest it's been. Actually, the highest it's been was about 3 months ago. But now interest rates are starting to creep down a little bit. So the interest rates are getting a little bit more affordable. But like I said, in the next 6 months, 9 months before the presidential election, the interest rates will come down. Credit score requirement, I put it as a disadvantage, but really a 575 score, it's not that bad. I mean, it's not that hard to get that. But if you're below a 575, you're not going to qualify. Some lenders do require 12 months experience owning and managing a rental property. Again, that's the underwriting criteria of that particular DSCR lender. Others don't. It just depends. And then the loan cannot be in a person's name. It's strictly a business-to-business loan. Okay, and then last, I got a couple more charts. So let's talk about a DSCR loan strategy, how and why people use it. And so this is basically how people use us, me being I'm putting on my hard money lender hat. So what you do as an investor, you find a distressed asset, you buy it for 60 to 7% of the ARV. After repair value, it's going to need some work. And then you're probably asking yourself, well, how the heck do I find that? Well, let me tell you something. If you guys are in Maryland, I'm seeing a lot of foreclosure activity in Prince George's County and in Charles County. So keep an eye on your newspaper. So I'm seeing a lot of pre-foreclosure activity on there, a lot of foreclosure sales. And so that's a good way to find distressed assets, drive for dollars, look at your tax lien property list, look at the estate sales. So you can get a property 60, 70% of the after repair value. And then what you do is you finance almost all of that deal, purchase and rental, with a hard money lender. So let's say it's called loan to cost. So the purchase price plus the renovation is called loan to cost. So we'll finance 95 to 100% of your deal, provided you're within that 60 to 65% after repair value. I'll fund the whole thing. And then what you do is you do your rental grade renovation, right? First of all, you need to determine your rental property type. Mainly my clients do long-term traditional rents. And so you get the property cash flow, put a tenant in there, and then you just go after 6 months, hold that title for 6 months, 6 months in a day, make your DSCR loan application, have a new stepped up appraisal at that point in time, because you'll get credit for that renovation. You'll get credit for buying it at a good discount. You'll get a stepped up appraisal. And if it appraises high enough, maybe you'll get a 3 to 5% bump in the market as well, like we've been doing, especially in Northern Virginia. And then you might be able to get a cash out. So basically, in this scenario, you're buying a property with limited cash by using a hard money lender. But remember, you're doing the work, and congratulations, because you're buying it at a discount. You're doing the rental grade renovation, right? Some folks do flip grade renovations and put tenants in there. And the reason why they do this is because I've had people tell me that, I do this because I want red carpet tenants. And so that makes a lot of sense, because they'll be able to get a higher grade tenant if they do a fixed grade, a fix and flip rental renovation with the stainless steel appliances, the granite countertops, so on and so forth. And so that works too. I like to do it the simple way. I like to just do a simple rental grade renovation, because in my experience, the rents don't really fluctuate that much. A 2250 or a 2500 is a 2500 rent. You might get 2,400, you might get 2,550, but you're not going to get 3,000 unless, of course, you're doing it to a short-term rental. And
Quick
so,
question.
yeah,
I'm sorry, you said there were two counties, Prince George's, and what was the other one with the
Charles County.
Charles? Thank you so
Yeah.
much.
Yeah, especially on the Maryland side, I'm seeing a lot of increased foreclosure activity. I mean, there's obviously a lot of foreclosure activity in Washington, D.C., but I was surprised the other day to see a lot of PG County and Charles County foreclosure activity. And if you don't know how to do it, just, either get a newspaper, print a newspaper, look at a newspaper online, WashingtonPost.com, and just look at the legal trustee sale notices and just see what's coming to auction. And if it makes sense, they have equity, try and buy them pre-foreclosure. But if not, just go to a foreclosure auction and see what they go for, because that's a good way to, buy, especially if you're a rental property buyer. Go into a foreclosure auction at PG County or Charles County. You're gonna be able to buy it for a little bit higher price point than a fix and flipper will buy it for, because a fix and flipper has to have a certain profit margin in there. If you're a buy and hold investor, you can afford to buy it 5 or 10% higher than the fix and flip investor, because you're just going to keep it and rent it out. So you're a little bit higher on the food chain. So keep that in mind. Okay. Then once you get your stepped up appraisal, take cash out if you can. If you break even neutral, who cares? If you have a $300,000 loan, you're refinancing it for $300,000, that's okay, because now you have a 30-year AM schedule with a lower interest rate and it's cash flowing. That's very positive. And then you just do it again and again and again. And so you guys are going to hear that as the Burr method, right? And this is how you use a hard money lender as part of your Burr method in a DSCR loan to take out that hard money lender. Now, if you can qualify for a conventional product and you don't mind doing it that way, I would do that first before I would do the DSCR loan. But you gotta, it's a full doc loan, and it takes a long time to get it qualified. So just keep that in mind. All right. All right. What do we learn? DSCR loans are a great way to build your rental portfolio. The LLC to LLC loans are there for a reason. You've got big insurance companies that have pooled mortgage funds that are supplying the liquidity to do these kinds of deals. And they're making a pretty good rate of return. There's no income requirement. I'm sorry, there's no personal income requirement. Underwriting is based on the income of the property, and that's it. It's primarily an asset-based loan, but there is some documentation, like there's an application. You're going to have to order an appraisal, and they might require some other pieces of paper that you might need to do, but there is some, but not much. And then the interest rate.
Sorry. Do they, do you do the appraisal like yourself and then start the process with them? Or do
Nope.
you have them start the process and they
No,
tell you who they want to? Yeah.
Well, on the hard money side, in my case, I do the appraisers myself. It's a broker price opinion. I know what the value is, but it's just like a normal loan in that whoever's doing the DSCR loan, they're going to order their own appraisal from a third party appraisal service just to get the value of the property. So it is a similar process as if you were getting a normal conventional loan.
Thank you.
You're welcome. Okay. And then last but not least, interest rate is determined by two factors. We talked about the debt service coverage ratio and what it is, and it's also determined by your credit score. So, in all practicality, a good looking borrower is somebody that has a 720 or higher credit score and a DSCR of 1.25 or more. You're a very good candidate to get this loan, and you should be able to qualify for the lowest possible rate of that DSCR lender. And that's about it. How did I do? I don't even know what time it is. Oh, wow. 55 minutes is a lot longer than I thought. So that's who I am, guys. Follow me on Instagram. Follow me on LinkedIn. We have a new education portal coming out soon. We have a free class on it. Real estate roadmap to wealth.com. And that's basically it. Unless you guys have any other questions, let me just click the chat. Okay, good. I do. Okay, I got a bunch of questions. I'm sorry. Do we get a copy of these slides later? Nikita might need to answer that. I could certainly supply them. Do they normally charge points on top of interest for DSCR? The answer is yes, they do. So that 7% rate that was the lowest and best rate at that time, that rate chart that I showed you was how they calculate the points. So it could be 7 and 2, 7 and 1, 7 and 3, all depend upon, where you fit in on that pricing chart. And again, the pricing charts change all the time. Can you send the list of DSCR lenders on your list? Yes, I'll do that. I'll send it out to Liz and Nikita. So they'll have a list. It's about 3 or 4. And I'll send that out. Cost of my book, I don't know. I think it's $19.99 hardback, soft copy, and then $7.99. We got an audio book that's $7.99. I think Kindle's $9.99. I don't even know. So it's below $10. How to find the roadmap to wealth and real estate investing. It's on Amazon. It's cheap. I was told it's pretty good. I don't know. I'm biased. Is there a penalty for early payoff? That's a good question. I don't know. I would talk to whoever the DSCR loan officer is. Usually they want them in place for 3 years minimum. But again, that's a case by case scenario. And do you have a class on tax liens? The answer is no, not yet, but we're producing it as we speak. The current classes that we have done now are X's and O's investing in real estate. We've done financial literacy in real estate investing. We've done how to find the money, which you guys have gotten a couple modules out of that, and then how to find distressed assets. And then the 5th and 6th course is going to be how to wholesale, build your capital stack, and then how to fix and flip to build your capital stack. And then the tax lien class, the hard money class, the invest in a pooled mortgage fund. Those classes are going to come in the next probably 3 or 4 months. I think that's it. I don't see any more.
Wow,
So
that
that's
went by
good.
that went by so fast. Thank you, Charlie. That was
welcome.
amazing. So next week you said it was, what did you say? It was on,
All right. So next week, for you guys, I'll cover how to use HELOCs to help your investing side. I'll talk
Okay.
about FHA assumable loans. I'll talk about VA assumable loans, which is different than subject twos. Remember, a subject two isn't a loan assumption. So for an FHA or VA assumable, it's a different process. Some of you guys probably already know about it. Some of you agents, but if you don't know about it, I'll talk about that, and maybe I'll try and throw something else in there as well, just because those 3 topics, and it might only be 30 minutes or so, maybe 40 minutes or so. It just depends on how many questions you guys ask. But I'll put that out there for sure. And if there's any other
Okay.
ideas, I could do that as well.
I was wondering if there's a list that you put us on. I just happened to be in the network and, someone said Friday, if you want to get on, jump on.
No, I don't know, because I think there's 2 lists. There's Nikita and Liz. They have you guys on their list, and then
Okay.
I put it out on, so I have a list of 400 or 500 people that have been investor friendly agents or investors that I put it out on. And then I don't know if we did a LinkedIn post or an Instagram post on this week. I mean, we've been pretty lax on that. We're not the best social media guys. I mean, we're pretty terrible.
but
So,
they can get on your list. You know how your newsletter, Charlie.
yeah, so I send out a weekly email or to investor friendly agents or agents telling, and I started doing this because we had a lot of fix and flips that we were doing at the time. And I wanted you agents to know what we had coming on the market, so that if you had a buyer, you could just put your buyer in there and buy the house without it going on the MLS. So that's why we started that list. But if you guys want to get on that list, I mean, I have a food for thought on there. I have art coming up inventory. And, a lot of times, especially in Northern Virginia, where the market is very competitive, if you can buy one of our fix and flips, I mean, we're not greedy about it. I mean, I don't have to put it on the market and get 10 contracts. I mean, if you guys like it and you have a client that wants to buy it, that's fine by us.
Okay. That's
So you guys
great.
are more than welcome to get on that list.
Well, I will reach out to Rebecca because I'm guessing Rebecca knows more about that. Rebecca Smith. Thank you.
Yeah. Yeah. Anytime, guys. Well, thank you, Nikita, for having me. Thank you, Exit
Okay.
Realty.
Thank you, Charlie.
I'll see you guys
See you
next week. All right.
week.
Thank
Okay,
you.
bye-bye. Bye-bye.